Good morning, everyone. Greetings and a very good day to all of you from the KPMG team in Oman. I'm Ashok Hariharan. I lead the tax practice for KPMG in Oman, and I will be the moderator for today's webinar on the manufacturing sector considerations for businesses as they get ready for the VAT go live date, which is 16th April 21 and is less than 40 days away. We will be having other sector-specific seminars in the coming days. This week we have two more sessions addressing the retail and the transport and logistics sectors. Before I begin, a few administrative matters. You may key in your questions through the Q&A tab on the right-hand side. We will address them during the Q&A session. You do not have to wait for the presentation to end to post your questions. After the webinar, please do take a minute to complete the survey, as your comments will be valuable to us. And as is the practice, we will be recording this session. Let's look at the agenda for this webinar, which we expect will take about an hour. After my introduction, we will provide you with a status update, including where we are on the much awaited executive regulations. I'm pretty sure businesses will get ready for the go live date as they did in Saudi Arabia, UAE, Bahrain, despite many challenges. However, the first few months leading to the first quarterly return will be even more significant for businesses. You will need to get continued guidance from your advisors and the tax authority, as I'm sure there will be areas where clarifications will be issued beyond the go live date. We will then take you through the Oman VAT framework, which is specified in the VAT law issued 5 months ago. We will thereafter deal with specific issues for the manufacturing sector, which, as we all know, is an important priority area for Oman's diversification agenda. This indeed has been reiterated in Oman's Vision 2040 statement. Many of the manufacturing entities in Oman export their goods both within the GCC as well as outside. How will this impact your VAT? How will the bill to ship arrangements be impacted? What about the input VAT issues on purchases of plant and equipment, spares, both of which could be entitled to customs duty exemptions? Indeed, the same is the case for raw materials. How will VAT impact these purchases? How does this impact the toll manufacturing arrangements? What if your entity is located in a free zone? Apart from these VAT issues, you need to also deal with your IT systems. What changes you need to incorporate in your ERP to not only deal with the day-to-day transactions, including tax invoices, but equally important, the reports that the system should generate to deal with the reporting to the tax authority, which currently will be on a quarterly basis. We will identify the next steps for you to not only be ready for the VAT go live date, but also beyond, to take into consideration new guidelines which are bound to be issued as both businesses and the tax authority settle into the new VAT era. In order to deal with all these topics, we have a distinguished panel of VAT specialists. We have Abha, who hopefully is a familiar face, having been in Oman for the last 3 years. She has not only helped us establish a strong indirect tax practice to complement our well-recognized corporate tax practice, but has also been playing a very important role in sharing insights on VAT to businesses and the tax authority. We are supported in Oman by Dermot, a very experienced retired KPMG partner. We are indeed fortunate to be able to get his vast experience across sectors, including the UK, Australia, and South Africa for the benefit of Oman. Lastly, we have Julie, who is not only a VAT specialist, but more importantly, a tax technology specialist. She has already been helping a number of businesses in Oman with upgrading their ERP systems to deal with the Oman VAT law. I will now hand over to Abha to provide a status update.
Thanks, Ashok. Good morning, everyone, for joining the session this morning and taking the time. So the VAT law was published on the 18th of October 2020. Takes effect 180 days from the date of publication, which is why we go live with VAT in Oman on the 16th of April 2021. In January this year, the tax authority has issued 3 decisions, of which 2 are on registration. One decision reiterates the monetary threshold for mandatory and voluntary registrations. So mandatory registrations for businesses with supplies in excess of 38,500 Omani riyals per annum. Voluntary registrations for businesses with supplies or expenses in excess of 19,500 Omani riyals per annum. The other decision on registration staggers the registration and go live, similar to Bahrain, but different monetary threshold. Businesses with annual supplies in excess of 1 million Omani riyal must register with effect from 16th April 2021. 500,000 to 1 million Omani riyals from 1st July 2021, 250,000 to 500,000 from 1st October 2021, and 38,500 to 250,000 from 1st April 2022. Businesses that are eligible for voluntary registrations may apply at any point in time. There are different registration processes for resident businesses with commercial registrations, resident businesses without commercial registration, and non-resident businesses. The monetary threshold does not apply for non-resident businesses liable for registration in Oman. Now, the tax authority has launched the registration portal on 1st of February 2021, and it remains open for the first tranche of registrations till the 15th of March. Just 6 more days to go. Although the criteria for tax grouping hasn't been published, the portal allows registration of tax groups. But in order to create a tax group, all members of the tax group must first be registered independently. The tax authority has also clarified that an entity in the special economic zone or a free zone cannot be a member of a VAT group with non-SEZ or non-free zone entities. And while the law sets out the framework, as they say, the devil lies in the detail. The detail on several substantive and procedural aspects are expected to be set out in the regulations. The final regulations are currently awaited. Technically, the tax authority has up to 6 months after go live to publish the final regulations. So in the worst case scenario, the final regulations may still be published as late as October 2021. But we do understand that the tax authority is working with the Ministry of Justice and Legal Affairs to release them as soon as possible and hopefully before go live. The tax authority is also working on general and sector specific guides to allow businesses better guidance for VAT implementation. Even then, at this point in time, there's clarity required on several aspects for businesses to plan for implementation and, more importantly, make system changes. And the long list on the slide is unfortunately only illustrative. Once we have better clarity on the conditions and procedures, the tax authority also needs to put out the actual procedure for notifying the tax authority of certain exceptions, for seeking approvals for certain exceptions. And then, of course, there are the formats. Formats for tax invoices, credit notes, debit notes, return formats. All of this needs to be done before we go live. And go live is just 39 days away. So I'll now ask Dermot to walk us through how Oman VAT will work once we go live. Dermot, over to you.
Hi, good morning, everybody, and thank you for your time. Thanks, Abba, for the introduction. Conscious that the go live is, quite close to us by now, so we're going to make a presumption that many of you will have already come to grips with some of the concepts of VAT. However, given that it's first time for many people, I'm just going to spend a little bit of time this morning just refreshing your memory about some of the concepts that are important and that will help you get a better understanding of how the tax works. The origins of VAT go back to the 1950s, a Frenchman called Maurice Laurier in 1954 advanced the concept of VAT as a replacement for multiple forms of sales tax that existed around Europe. They needed a harmonized system when they were introducing the European Economic Community, which later became the EU, and that was the system that was advanced. So that's where it comes from. It is a tax that is charged at each stage in the supply chain, so it cascades its way through the system. It's important to remember that in most instances, VAT is not a tax on business. So you claim back the tax that you were charged by your suppliers, and you charge VAT to your customers. You net one against the other, and you remit the revenue to the tax authority which is effectively the tax on the value you added, hence value-added tax. It is, as I say, ultimately borne by the consumer in most instances, except for some special cases such as financial services and other exempt activities where the business steps into the shoes of the final consumer. There are many exceptions and complexities to what should in theory be a very simple tax. It applies now in over 169 countries worldwide, and in Europe it is one of the most, if not the most, litigated tax. Could we have the next slide, Claire, please? So there are some important concepts. Just to save time, I'm not going to go through all of these. I'm just going to pick one or two that are important to refresh your memory. The term supply is a term that we use in the VAT world. In business, you might call it sales, but for tax, it is much more than sales. It can be the free gifts of goods to customers or third parties. It can be the removal of inventory from stock for non-business use. That can also constitute a supply. So we tend to talk about supplies rather than sales. There are a number of concepts such as time of supply, which is important, place of supply, and value of supply, and we're going to come to those in a little bit more detail. There is another concept that's rather alien, and that's the one about reverse charge, which you'll have seen on that slide. Reverse charge is where you import services from outside of Oman, and where the supplier is not registered for VAT in Oman. To avoid there being no VAT on the supply, the customer or the importer of the service effectively steps into the shoes of the supplier and charges the tax to himself and accounts for it as an output. If, however, that supply was or that imported service was used for the purpose of acquiring or for making a wholly taxable supply, he gets a simultaneous input tax credit. You can go on now, Claire. Thank you. So there are various types of supplies. I'm going to cover just three at this point. Standard rated, which is the term we use for the 5% rate. It's currently 5% and will be from the go live date, but the global average is somewhere between 15 and 20%. So there's plenty of scope for the tax rate to increase, such as the increase we saw in Saudi Arabia. There are two other kinds of rates, zero rated and exempt. These are often confused. Zero is a rate of tax and is different than exempt. Exempt supplies are specified in the legislation. We'll come to what is exempt in a moment, but the consequence of making exempt supplies is that you can't claim any input tax on any costs associated with making that supply. So effectively, the exempt supplier becomes the final consumer. Zero-rated supplies, however, are different. There is still no output tax on the supplies, but the supplier is allowed to register and recover VAT charged to him on his inputs. So those two are often confused, but it's important to remember that they are different. If you go ahead, Claire, please. So as I mentioned, exemptions, and there's the list of them. I'm not going to go through them all. Exemptions are seen as an exception to the general rule, so they have to be interpreted narrowly. The exemptions are provided in the decree law, but we wait on the executive regulations to understand some of the detail around them. Zero-rated supplies, again, are listed there, including food and medicines, and also the international transport of goods, which will be relevant to the manufacturing sector. Zero-rated supplies are also for supplies which are exported outside of the GCC, and again, this is relevant for the export sector, or manufacturing sector, should I say. Goods that are subject to suspension of customs duty may also be subject to the suspension of VAT. And the final category is what we call out of the scope of VAT, which are supplies that are just not within the remit or ambit of the Oman VAT legislation. So an example would be where a company acquires goods in a third country and sells them to a customer in another jurisdiction outside of the GCC. Those supplies are outside the scope of VAT and whilst they are a business supply and there's no restriction of input credit, there is no output tax or indeed no reporting of the supplies. If you can go ahead. Thanks, Claire. So as I mentioned earlier, in terms of supply, we also have the concept of deemed supplies. Now, an important basic understanding of deemed supplies is that you must have been entitled to claim an input tax credit in the first instance for those goods. And if you use those goods for a personal purpose or supply them to somebody without any consideration, or you change the use of them from what was previously making a taxable supply to a non-taxable supply, you have a deemed supply. So it's important to remember, but you may have certain acquisitions which you onward supply, but if you weren't entitled to an input tax credit in the first place, you can't have a deemed supply. Go ahead, Claire, please. So as I mentioned earlier, time of supply is important. I'm only going to cover the general rule. The other exceptions are there on the screen. You can read them yourselves. The general rule is that it is the earlier, and I emphasize earlier, of the date you made the supply, or the date you issued a tax invoice, or the date of receipt of payment. Those are important principles to remember, particularly if you receive a deposit or an advance payment for a supply. You are deemed to have made a taxable supply at the date of receipt of payment equal to the value of the amount received, and you have to issue a tax invoice accordingly. So there can be an instance in those cases where you will have more than one invoice for the same supply. Move on. Thanks, Claire. So the place of supply determines which jurisdiction has the taxing rights. And in this instance, the basic rules for a place of supply of goods is if they're supplied without transport, is where they are physically made available to the customer. And if they are supplied with transport, it's where the transport begins. There are particular rules for oil and gas sector, which we won't go into this morning. There's a separate webinar on that later on. Supplies of services, VAT legislation defines that anything that's not a supply of goods is a supply of service. And a supply of a service can be passive as well as active. So if you allow something to happen in return for a consideration, you can be deemed to be making a supply of a service. There are a number of rules around special cases, which we will cover in subsequent webinars, and they're listed there on the screen for you. For relevance to the manufacturing sector will be the transportation of goods, which will be the place where, as I say, where the transport originates, and services related to real estate are always where the real estate is physically located. If you move on, thank you. So as I mentioned earlier, VAT cascades through the tax chain, and one of the basic principles or important first steps is on input tax recovery is how do I claim my input? How do I know am I entitled to claim a tax on an overhead or a direct purchase? So the acquisition must be used or intended to be used for the making of an onward taxable supply, or indeed an exempt supply. So there is a principle in VAT called direct attribution. The first step is you look at, was the expense incurred directly in connection with either the making of a taxable supply, that's 5% or zero rate. If it is, it's wholly recoverable. If it's directly attributable in full to the making of an exempt supply, then you can't recover the input tax unless that supply is made to somebody outside of Oman. Other important principles are there on the screen, but there's two that are marked in red that I just want to cover. There are some restrictions on the recovery, specific restrictions on recovery of input tax, and those are on blocked goods that are prohibited to be imported into Oman or supplied in Oman. There are also certain specific categories of expenses, such as entertainment expenses and passenger motor vehicles for private use, that are specifically prohibited from recovery of input tax. The last point on this slide that I wanted to make was the question of pre-registration input tax credit. We're still waiting on the executive regulations to let us know how far back you'll be able to go, but the law does provide that VAT that was incurred prior to the date of registration of a business can be recovered. An example there will be, because of the staggered introduction of VAT, some businesses will only be registered as late as next year, but they will have started to incur VAT from April this year, and then we will need specific rules to be able to see how far back they can go in order to recover input tax. Three basic principles of compliance with the tax. There are records that you have to keep, returns that you have to file, and if your input tax exceeds your output tax, you may be entitled to a refund. On the records, the important one is you must maintain the records for 10 years, and they must comply with the specifications in the executive regulations, which, as we say, we've yet to see. Returns currently proposed to be on a quarterly basis, although that may change in the future. Other GCC countries have moved from quarterly to monthly, and monthly is more the international norm, particularly for larger businesses. If you move to the next one, please, Claire. So that's just a quick whiz through or recap for you on the basic principles of VAT, and now I'll hand over to Abba, who's going to talk about some manufacturing sector specific issues. Abba.
Thanks, Dermot. So now to the peculiarities of the manufacturing sector. We've put a few issues on the slide up here, but these again is an illustrative list. It's not exhaustive. And for each of these transactions that we'll discuss today, we can discuss the general premise, but in order for you to conclude the tax treatment and the specific impact on your business, you'd have to be focused on the facts of the transaction for you, the contractual terms, and the commercial arrangements. So let's first begin with bill to ship to arrangements. This is where the place of supply rules play special role. As Dermot said earlier, the place of supply rules help businesses ascertain which jurisdiction or which country has the right to tax a transaction. So when you have a bill to ship to arrangement where your bill to party is a local entity and the ship to instructions are local, it's a fairly easy scenario to deal with. Unless the goods are specifically exempt or zero rated, you would, in most circumstances, charge a standard rate of VAT to the party that you're billing these goods to. But how do you deal with bill to ship to transactions where, let's say, you're billing to a local customer who's given you instructions to ship the goods overseas? You'll assume the responsibility for shipping the goods. You will have the proof of export, the official proof of exports, the customs proof of exports. But can you, given the fact that the customer is a local entity, treat this as an export of goods and zero rated? Similarly, what do you do in case of transactions where the bill to party is a non-resident customer and asks you or instructs you to ship the goods locally? Because the goods are moving from within Oman to Oman and there is no physical export, would these transactions be standard rated? Or because your customer is a non-resident customer, would you zero rate these transactions? If these are standard rated, then would you create an obligation, or would this transaction create an obligation on the non-resident customer to obtain a VAT registration in Oman? If the customer obtains a VAT registration in Oman, would she or he be required to charge VAT to the final billing party? And if the customer does not obtain a VAT registration in Oman, would she or he be eligible for claiming VAT of the input credit of the VAT which is charged by you? So bill-to-ship-to arrangements in themselves are very peculiar and require an assessment of the facts to ascertain what the tax treatment should be and what the compliance obligations for all parties involved should be. Drop shipments. Earlier, Dermot explained transactions where goods are purchased and sold outside Oman. They never make physical entry into Oman or exit from Oman. Would these be treated as out of scope for the purposes of VAT? And if these are treated as out of scope for the purposes of VAT, would this impact your ability to claim input VAT credit on expenses that are directly or indirectly attributable to these transactions? Incoterms. Incoterms, the interplay between Incoterms and place of supply rules help you determine the tax treatment of every transaction correctly. Common instances where you need to watch out for the Incoterms. When you're making a sale on DDP basis, are you exposing yourself to a registration or compliance obligation in the destination state or the destination country where the ownership in the goods eventually passes from you to the end customer? Or the other example that immediately comes to mind is when you make sales to a customer who is going to take the goods physically out of Oman, so will be responsible for the removal of goods from Oman to a foreign jurisdiction, but the Incoterms for your sale to the customer are X worth. In this instance, would you treat your sale to the customer as zero rated, or would you treat it as standard rated? Because at the end of the day, the obligation to decide the tax treatment on supplies made by you is on you. We've seen in the rest of the region that there is a concept of indirect exports. We expect the executive regulations to also set out the conditions and the concept with greater detail. But in order for you to qualify for indirect exports and consequent zero rating for the transaction, you would, in all circumstances, need to have the proof of export. In this case, it is your customer who will be arranging for the logistics of the goods. So it will be important that you liaise with your customer in order to have the evidence of export on record with you. Because in the event of a future audit or assessment, the tax authority will expect you to produce these documents. Also, in the rest of the region where VAT has been implemented and where indirect exports are recognized, the process of obtaining the customs declarations for exports and making sure that the goods leave the country is time bound. Usually, it is expected to be completed within 90 days from the date the first supply is made. The other issue that we've seen has come up, especially after implementation in the UAE as well as KSA, is the dispute between who is eligible to recover input VAT paid at the time of import of goods. Is it the importer on record or is it the owner of the goods? Often when businesses make purchases on DDP basis, they may be buying from foreign suppliers who may not appoint logistics companies for customs clearance, who may ask the business in Oman to use their customs code to import the goods into Oman. In which case, when the customs documentation and in the future VAT documentation is filed at the time of customs clearance, it is the business in Oman that will play the importer on record. But given the Incoterm of the purchases, the importer may not be the owner of the goods at the time of customs clearance. We have seen the tax authorities in KSA as well as UAE question importers on record availing or recovering the input VAT of tax paid at the time of import when they are not the owners. So you would need to carefully assess and identify instances where you play the importer on record but are not the owner, and understand whether you would be eligible to recover the import VAT paid or not. In the UAE, we do know that there are clarifications which have been subsequently issued, mechanism which has been put in place just to make sure that the right taxable person avails the input tax credit. And if the common transactions didn't require special attention, is the special arrangements, what happens in case of contract or toll manufacturing, job work, or transactions that require not just manufacturing, but supply and installation as well. In contract or toll manufacturing, let's say if you have a cross-border transaction, you may be receiving capital equipment or raw material as well as IP from the principal. In that case, at the time of import of these goods or import of these services, are you required to pay import VAT or VAT under the reverse charge mechanism? And even if you do pay import VAT at the time of customs clearance, are you, as a mere importer and not the owner of goods, eligible to claim input tax credit? Similarly, for job work transactions, when you get material from your principal overseas and you clear these goods into Oman, if you do it under a customs suspension, you may be eligible for a VAT suspension. But if you don't do the imports under a customs suspension, would you be required to pay VAT on the goods which are issued to you free of cost? If yes, again, the question arises, if you're just the importer on record, not the owner of the goods, would you be in a position to claim import VAT or not? What's also important is that you look at the classification of the supplies you make in order to ascertain your tax obligations. As Dermot mentioned earlier, the scope of exceptions and zero ratings do include certain entries that may impact the manufacturing sector. So you've seen that there's an exemption which is extended to goods that are related to healthcare. There is a zero rating which is extended to medical products. There is a zero rating which is extended to food items. And earlier in January this year, the tax authority has issued a decision which lists 93 food items based on HS codes that would be eligible for zero rating. Of course, the conditions that are attached to the zero rating are still awaited. But what this means is that if you manufacture these goods and sell them in Oman and they fall under the right HS codes, you may qualify for a zero rating. So although these are not instances of imports, these are instances of local transactions, you may still need to look at what would be an appropriate HS classification for these products you manufacture and whether they would qualify for a zero rating or an exemption as the case may be. In the event you make an incorrect assessment of your tax obligations, so let's say it should be a standard rated supply, but you assess that you're eligible for zero rating incorrectly, this means that you've short paid taxes, which could expose you to additional tax and administrative penalties in the future, not to mention the tax in itself. On the other hand, if a particular supply or a product is eligible for zero rating, but you charge VAT on it, that would, other than commercially disadvantaging you, also mean an excess payment, which you may be able to get a refund of from the tax authority, but that will involve a cash flow impact in itself. What's also important to look at is the schemes and promo arrangements. Schemes which could be discounts that you put on the face of the invoice at the time of sale. Are you able to deduct these from your taxable value? Schemes could also be post-sales discounts, which are based on volumes, which are based on turnover, or any other criteria. Are you able to issue tax credit notes and adjust the VAT liability that you originally recorded on these transactions? What are the conditions? How should your credit note look? And how should you be reporting these on your tax returns in order to claim an adjustment in a compliant manner? And let's say you do adjust your VAT liability. You issue a credit note, but your customer does not reverse the input tax credit that she or he originally claimed. Would that in any way impact the adjustments of tax liability that you've made? That's on schemes. You also may have promo arrangements going with your channel partners, modern trade, retailers, wholesalers, as the case may be. Often we've seen that there are disbursements that the channel partners claim of expenses that they've incurred. They do not, or they may not issue documents in order to recover these from the manufacturer. These may be netted off from the payments that are required to be made by the channel partner to the manufacturer. There could be other advertising and promotional spends. There could be from modern trade fees in the form of listing fees, product placement fees. And it's not unusual, as I said earlier, for the channel partners to just net these transactions off from the amount payable to the manufacturer. Can that continue as such? Would the channel partners be required to issue a tax invoice if this is viewed as a service? Would the manufacturer be required to issue credit notes if this is viewed as a discount? All of these would be required to be assessed as independent transactions. Some of these may even require changing the processes and ways of working that have probably been in place and been followed for years altogether. Input tax recovery. As Dermot mentioned, there will be certain expenses on which input tax credit is blocked, and it will be important to assess your obligation to reverse these, because if you claim incorrect input tax, that means you are exposing yourself to a potential administrative penalty and additional tax. What will also be important is when you look at your profile of revenues, it is not just the routine revenues from supply of goods. You would also need to look at other income you could have as a business, even if nominal, other income from financial services such as extending loans to intercompany or group companies. You could have dividends from investments that you've made. You could have interest that you earn from fixed deposits. You would need to assess whether these would qualify as financial services which are exempt from VAT in Oman. If they are exempt, this would mean that you would need to make an apportionment of the input tax that you've recovered on expenses which are directly attributable to these revenues or common to these as well as taxable revenues. So it will be important to look at the input tax recovery and how it plays out. Any cost on input tax recovery dents your profitability. Transitional contracts and supplies will require special attention. The Oman VAT law is clear. Any supplies that you make on or after the 16th of April 2021, if you are registered, will be liable to VAT. You will have to pay the VAT unless these goods are zero rated or exempt of cost. You would have to pay the VAT to the tax authority. Doesn't matter if you've raised an invoice before 16th of April. Doesn't matter if you've received an advance payment for these goods before 16th of April. If the supply is made after 16th, VAT is payable. The question is, can you recover this VAT from your customer? And it may not be a yes in all circumstances. The Oman VAT law is also very clear that if your contract, and the contract may be in the form of an agreement, it may be in the form of a PO, or any other document that is a commercial agreement between you and your customer. If your contract does not have a VAT recovery clause, then your consideration will deem to be inclusive of VAT, which means VAT will have to be borne by you. You will not be able to collect this from the customer unless you amend contracts or you agree differently commercially. It will also be important to have cutover strategies in place for you to understand what happens when your customer returns goods which were sold before the 16th of April. Or similarly on your purchases, when you purchased goods before 16th of April, but you return them after the 16th of April. How do you deal with these transactions? Vendor selection is also equally important. You may today be buying from vendors who may or may not qualify for registration. What you need to consider is, after go live, when you purchase from a registered vendor, she or he will charge you the cost of supplies plus VAT. And depending on the nature of expense, you may be in a position to claim input tax of the VAT that is charged by your registered vendor. But when you buy from an unregistered vendor and she or he in the supply chain somewhere has incurred VAT costs, because they are not registered, they will not be able to claim input VAT. And if they are not able to claim input VAT, they may bump up the prices at which they supply to you. And at the end of the day, you may end up paying the same amount to your vendor who's registered and your vendor who's not registered. But when you pay to the vendor who's registered, at least you have a portion of that amount that you may be in a position to recover. Whereas when you're buying from a vendor who's not registered, he's charging you the same amount, but as the cost of supply, no VAT on the transaction. And at the end of the day, all of these transactions that you have, whether they are purchases or whether they are sales, you need to see how they impact your cash flow and profitability. So when you're purchasing or importing goods, the general rule in Oman is that you will need to pay VAT upfront in cash at the time of customs clearance. The VAT law does allow importers to apply for a special permission from the tax authority where they are not required to pay VAT in cash at the time of customs clearance, but instead they are allowed to put this on the tax return for the tax period in which the imports were made, and effectively this only becomes a entry on the return. Now this is automatic in the UAE, but like Saudi, in Oman, this has to be by way of a special procedure. If a business is not granted the special permission, which means that you will need to assess the cash flow that you need to incur when you bring goods into Oman. In addition to this, you'd also need to see when you use these goods in making exports, the exports will be zero rated. You could also be using these goods in making local supplies which are zero rated. In both instances, you will end up, in most circumstances, accumulating input tax on all the purchases that you have made with VAT. And if there is an excess input tax credit, you would logically want to apply for a VAT refund. So your cash is likely to get stuck from the point in time you've made the import, paid VAT on the imports, you've made local purchases, paid VAT to your vendors on the purchases, use these in manufacturing, produced goods which you've zero rated for sale in Oman or overseas, filed your tax return, filed your refund application, and then waited for the tax authority to process your refund application, which initially could take a few months, if not a couple of years. So you need to look at the cash flow impact that all of this is going to have on your business and make sure that you have the required working capital that VAT may need you to have. And the law, of course, allows you optimization opportunities. So if you have intra-group transactions, you may want to consider grouping, but you will need to assess or weigh the pros and cons. Because with grouping, while you don't have to charge VAT on transactions within members of the same group, you're also exposing the members of the group to joint and several responsibility. You may also, depending on future investments that you're looking to make, want to set up units, especially for export-oriented businesses, in a free zone, which are eligible for VAT suspensions. But the conditions for suspension of VAT in a free zone at the moment are unclear and could be onerous as and when these are published. So these are a few issues that you certainly need to factor in, but this is just the VAT side of it. The IT is an entirely different ballgame and requires equal attention, if not more. I'll ask Julie to quickly walk you through the VAT touch points on the IT systems and how you can prepare for these. Julie, over to you.
Yes, thank you, Abba. So I will basically just show you just one slide, and it's a very busy slide, but I think that actually captures the complexity of where all the VAT touch points are in your IT landscape. And we only have very limited time left before the go live date. And even though there are a lot of things still maybe unclear, one thing is clear on the IT systems that they require time to actually be set up and be tested before you can switch them on. So that means that even though maybe you're not certain about certain positions on your VAT treatment, you will need to give your IT team some time to do the setup and to see whether things are actually, whether you can operate in the VAT environment. Because in the manufacturing industry, you are always confronted with a high volume of invoices, and you typically would invoice to, at the same time that your goods are being shipped. So that means that you cannot delay the invoicing from your system. You will need to be ready on the 16th of April. So what is it that you can already do at the moment, even though you might not have 100% certainty? Well, now that the companies are already registering for VAT, you might have already seen that some of them are issuing communications to their customers and vendors and informing them of their own VAT number and requesting others to provide their VAT numbers to them. Why is that important, and what's the system relevance of it? Because typically you would want to know whether your vendor is registered or not and have that captured in your system to actually being able to control my vendor is charging me VAT. Is that correct? So once you have their VAT number in your system, you actually know that they are registered, and hence any VAT that they're charging is it doesn't necessarily mean that it's correct, but at least they're allowed to charge you VAT. So that's one of the controls. If you're charging VAT to your customer, then most probably they will want to have their VAT number on the invoice to be able to recover that VAT. So you want to capture your customer VAT numbers in the system. Even if you are operating in, say, UAE or KSA already, and your system is able to capture those VAT numbers in those countries, you might still need to do some additional check for Oman, because the difference in Oman is that the VAT number is not just numbers, but it's alphanumeric. It starts with OM, and then you have 10 digits. So that might be a challenge for some of your systems, which needs to be checked and tested and made sure that you can actually operate with that. So definitely a point to already be addressed, and be sure that your systems are capable of dealing with this. Another important thing, what I already mentioned, is to make sure that you are actually able to issue your invoices from day one. The invoice format has been communicated by the authorities through one of their guidances. So at least that is a minimum of the requirements that you want to be able to comply with. And possibly you would need to do some adjustments to that once more regulations are released, but at least start with a minimum, at least have those addressed. And one of the challenges that we also see is if you issue invoices in foreign currency, then you would need to make sure that you have the Omani Real values also on that invoice according to the correct exchange rate. So that is something that definitely wasn't a requirement before and needs to be addressed. And if you're not operating in other GCC countries that already have that requirement, then definitely you would need to look into this, because you need to see how does that fit your current invoice format. Do you have a place to have all these values and foreign currency and Omani Reals all on one print form? So another, just basically the last point that I want to touch upon, because we still want to leave some time for Q&A. Another important point is that even if you don't know all of your VAT treatments yet, what you want to make sure is that at least on the purchasing side, you will probably be confronted with all the different variations. You will need to manage some of the blocked input tax. You will have probably some purchases that need to be treated as a reverse charge because there are some services coming to you from outside Oman. You will have definitely imports, local purchases with VAT, with 5%, with zero rate. So make sure that you have all of these variations set up in your system in form of tax codes so that once we have all the details, you can link the different types of transactions that you have with those different tax codes. But at least the tax codes should be there, they should be in place. And if you don't use one of them in the future, well, that's better than trying to implement a new tax code while you're already live. Or worst case, when you don't have enough tax codes and you need to segregate things for reporting based on Excel lookups and trying to distinguish things in the reporting phase, because that's going to definitely pose some challenges. So these are just this is just a very quick run through, but there is a lot to do, and yeah, so Abba will take you through the next steps, what we think you should be looking at now.
Thanks, Julie. So VAT clearly impacts all facets of business. It's not just a tax or a finance project, it is a business transformation project. Businesses need to look at every part of their operations to be VAT ready and work collectively towards a smooth transition. VAT implementation can be complex, especially when the legislation is not published, but it's not impossible. So with 6 days to go for registration, 38 for go live, and 143 days for the first return, prioritize. If we can move to the next steps, focus on the mission critical items. Understand your registration obligations, know your registration options, VAT group or independent registrations, weigh the pros and cons, register in time. Failure to register could attract penalties. VAT is a transaction tax, list down all the transactions and make sure that you understand the tax treatment and the documentation and reporting requirements. Apply for exceptions if eligible. Review contracts. VAT is not intended to be a cost to business, but in the absence of a VAT recovery clause, because of the transitional rules, you could end up paying for VAT out of your own pocket. Understand the impact on masters, tax determination, document layout, tax reporting. Identify the VAT touchpoints in the IT landscape, configure and test systems, and plan a cutover strategy. Transition to VAT generally requires careful planning. Having to transition in the middle of the month only adds to the complexity. And train. Educate your team, operations as well as the front line. Educate your customers and educate your vendors. And finally, go live. But that's not the end, that's just the beginning. There will be clarifications after the 16th of April. You may need to reassess your tax positions. You may need to revisit system configurations. Stay agile, and if necessary, invest in post-implementation reviews. That's it from us today. We can now wrap up the session and move to question and answers. Thank you.
Okay, that's excellent. I think so many issues that all the panel speakers have identified for the manufacturing sector and the IT issues. Let's look at the questions that have come. I think I'm sure there will be a number of questions which people would have, but let's deal with those which have already been communicated. So I will just go through in random sort of order. One question is, raw materials are sometimes exchanged between companies on loan basis. How will VAT impact these transactions? No invoices are made, but inputs are taken on a loan basis with the same quantity being returned later. So Abha, do you want to provide some comments?
Sure, thanks. I think you need to look at the specifics of the arrangement. While you may want to call it as a loan arrangement, can this qualify as a barter transaction? Can you assign a value to the goods that you are exchanging? Can you say that there is a transfer of ownership, there is actually a supply, even if it's a deemed supply? Does that mean that you need to charge a VAT on the supply that you make? And you could have the other party issue an invoice to you when they're supplying the material to you. That's one way of looking at it. Or do you want to think of this as a deemed supply, where you abstain from availing input tax credit on the goods that you are exchanging on loan basis? So I think you would need to look at the facts of your case. This could qualify as a barter transaction or a deemed supply and could require VAT compliance, could require you to issue a tax invoice, and unless the goods are specifically exempt or zero rated, could require a VAT charge. And at the end of the day, depending on what kind of expenses these are, depending on what kind of businesses both parties are in, this may just be an exchange of documents where input tax credit is available to both parties. So it may not have a cash flow or a VAT cost impact to either businesses.
Okay. I think the second question I could pose to Dermot. This is regarding exports. So one of the attendees is asking, their company exports to Yemen, but through a dealer based in Oman. So the dealer sells within Oman as well as exports to Yemen. Can our company avoid the 5% VAT for the export portion of sales, which is invoiced to the local dealer in Oman?
Yeah, the place of supply rules, as we saw earlier, make that if the goods are sold with transport, the place of supply is where the transport begins. So the first leg of this is in Oman and would be a domestic supply. The legislation does envisage indirect exports where you export through a third party, but the details of that are yet to come in the executive regulations. Generally speaking, in other jurisdictions, if you work on an indirect export, you may be taking significant business risk that your customer actually does arrange for the export of those goods in the end. So you might zero rate a transaction. If the goods never actually ultimately leave the country, then you are liable for the tax. And as Ava mentioned, depending on your contract, you may have difficulty recovering that later. So it does come down to the detail, which we've yet to see. Basic rule, I would say, is make it as a domestic supply to the dealer and charge him the tax. He can recover if he's subsequently exporting it outside.
Right. And this question also, Dermot, maybe you can address. It is to do with exports, but a different arrangement. So here the customer is based in a special economic zone, and the delivery takes place outside Oman. So what will be the VAT treatment?
So, well, it depends. If we're directly transporting those goods to outside of Oman and indeed outside of the GCC, then they will be a zero-rated export, even though we're billing to our customer who's in the special economic zone. So if I understood the question correctly, then if those are the flows, then that's the consequence for VAT purposes.
And to add to what Dermot mentioned, although the details in the question are a little sketchy, what we also may want to consider is the VAT suspension that applies to supplies made to the SEZ. Goods or services which are supplied to, from, and within special economic zones. And special economic zones could also include the free zones that we have in Oman, subject to conditions, of course. That in itself may qualify the transaction for zero rating or a VAT suspension. But then again, the question is a little sketchy. So if we understand the facts better, we can comment better.
Okay. About this question to you, please.
Sure.
So what is going to be the VAT treatment for supplies to ministries and government units? Will it be 0%, exempt, or standard rate would apply?
Sure. So if you look at the UAE VAT law, and I'm trying to draw comparison before I answer the question for Oman. If you look at the UAE VAT legislation, it identifies government entities. It makes exceptions for supplies made to entities that qualify as government entities. And usually these are ministries or quasi-government bodies that are engaged in sovereign functions which are not competitive or for commercial purposes in nature. If you look at the Oman VAT law, it does not make any exception for government entities or supplies made to government entities. So unless the executive regulations make a provision of such sort, which we are not expecting at this point in time, but in the current state, supplies that a business makes to government entities, quasi-government entities, or ministries would be liable to a VAT at a standard rate, unless the supply in itself is eligible for a special treatment, which is standard rate, which is zero rating, exemption, or suspension.
Okay, clear. The next question could be answered by Julie. So the question is, because Oman's VAT go-live date is 16th April, do businesses have to change their invoice sequencing from that date? For example, do we have to start afresh in terms of numbering those invoices? Or can the current sequence of invoices, assuming that that starts from the start of the month, 1st of April, continue beyond 16th April?
Well, obviously we're in a unique situation in Oman that we are kicking off VAT in the middle of the month. This is not something that at least any other countries that I know of done before. But what essentially the VAT law prescribes is that we have a unique sequential number that identifies an invoice. Therefore, I would say as long as you can show that this invoice, that number has not been used before, then that should be sufficient to uniquely identify that invoice. Therefore, I would not restart your sequence afresh. I would just continue if your sequence is showing that there are no gaps and there are no missing invoices. If you do use, for example, your invoice sequence not as an invoice sequence, but rather a sales order, and therefore if sales order does not go through, you will lose that number, I would actually reconsider that approach to make sure that your invoice numbering does not have gaps. So yeah, there are some things to think of, but it's not necessarily requires a new fresh start.
Right. Abba, this question possibly to you. Is it required to raise a VAT invoice in case of sales returns pertaining to the sales which were made before the VAT became effective?
Right. So this may be coming from someone who's had to deal with GST implementation in India and has been scarred with that experience. But what we would expect is that if you have made a supply prior to 16th of April, when you made the original invoice that was without VAT, you've sold these goods to a customer. Customer returns the goods to you after the 16th of April. You issue a normal credit note to bring the goods back and have the entries which are done for bringing the goods back in. Because there was no VAT that was applied at the time the transaction was made, and this is a sales return, not a sale by your customer to you, you should be you shouldn't have to have any other VAT compliant documents. The original invoice can either be can be adjusted by way of a commercial credit note.
Okay. A few more questions. I'm conscious that we are past the 1 hour time, so maybe another 3-4 minutes we will take before we wrap up. So this question is on the payment of VAT on import of goods. When are we required to make this payment? Abba, if you can please, or Dermot, yeah, please.
Yeah, sure, happy to take that. Generally speaking, the VAT will be payable at the time the goods are cleared for customs purposes, and the value will be the customs value plus any duty. So you take the customs value of the goods, add the duty, and then calculate the VAT at 5% on that amount. And the normal rule is that that will be payable on clearance unless, as Ava mentioned, the proposed deferral scheme comes in that allows you to defer the duty to a later date. Generally speaking, deferral schemes require you to provide a bank guarantee in case of a default by the importer. But the basic rule is at the time of customs clearance.
Right. About this question for you, can we get exemption from import VAT given that manufacturing entities qualify for customs duty exemption?
So the customs exemption is under the customs law. What the VAT law recognizes is customs suspensions, not customs exemptions. So if you are bringing the goods in under a customs exemption, the goods are not exempted or zero rated for VAT purposes, you would still need to pay an import VAT at the time of import, or if it's deferred at the time of filing the returns. If you bring the goods in under a customs suspension, say temporary admissions, which you know you're going to re-export, or import for re-exports are common examples. In customs suspensions, you may be able to apply a VAT suspension, so you don't have to pay VAT at the time of import. In the event your customs suspension ends in Oman and you release the goods from the customs suspension, at that point in time, you'd also expose yourself to a VAT payment.
Okay. I think one last question for today. And this is, the question is quite straightforward. How long do you think it will take to get VAT refund? Are there any provisions mentioned in the law which requires the tax authority to provide refund within a stipulated time? Let me make it easy for you.
Yes, thank you. Because here you're asking us to speculate on how much time it will take for a taxpayer to get money out of the government. Let me think. But if you look at the VAT law does not at this point in time set a timeline for the tax authority to disburse the payments. This may be set out in the executive regulations or the tax procedure rules, but we don't know for sure. If we look at the experience within the region, whether it's UAE, whether it's KSA, whether it's Bahrain, initially it took the tax authority slightly longer to disburse refunds than in steady state. And the reason it takes time is once the business applies for the refund, the tax authority, before they give money back to the taxpayer, would want to do some sort of an audit of the taxpayer, even if it's a preliminary desktop audit. And for things to fall in place, it will take time for the tax authority too. So the short answer is the tax authority has not put out a time limit in the tax law. And even if there is a timeline put to it, practically businesses should reconcile to the fact that initially refunds will take longer than in steady state.
Yeah, I do think and I hope that the executive regulations will contain some clarity and direction to the tax authority to dispose of some of these applications for refund within a stipulated time. So I think we have had a very good session. I'm sure there will be a number of questions that you all may continue to face. We are here in Oman to help you. As I mentioned at the beginning, we have a very strong VAT practice. You have seen a few of the people in today's presentation. You will see a few more, the other people, senior people in the rest of these sessions, which we would have over the next 10 days. And I would think that, yes, we will go through the critical phase of from now till go live phase. But it is very important to continue to be engaged, see what is happening, what are the further developments happening on the tax front, on the VAT front from the tax authority. There will be guidelines issued, circulars issued. So stay tuned. We at KPMG will be very happy to assist all of you. Have a good day. Thank you. And thank you.
Thanks, everyone. Have a good day. Bye.
Thank you. Bye-bye.